In 2009, Irish house prices collapsed, falling 55%. It was a tumultuous end to a housing bubble that spectacularly burst. It was a similar story around the world. In places like Florida and California, prices also fell 50%. A decade of over-optimism, reckless lending, and a bubble sentiment caused prices to soar, only to then spectacularly fall. It wasn't supposed to happen, but the house price fall was so steep and default so rampant, it led to a global credit crunch, with banks around the world running out of cash. UK house price inflation went from 25% to minus 16%. It was a moment of reckoning. But what have we learned since that crash? Are there any similarities, or is this time different? There are 7 lessons that we can learn from past house price history, which is relevant to today. But first, I'd like to go back to the 1970s. It was a very different country. 300,000 coal miners, black and white TV, depressed inner cities, and a sense the country was losing its way. But in the early 1970s, house prices were soaring. But then, in 1973 and 74, the oil price shock caused rampant inflation, a surge in interest rates, and a deep recession. In fact, it all sounds quite familiar. With interest rates rising to 15% and the economy going into recession, what happened to house prices? You might expect that to be a recipe for falling prices. But nominal prices didn't fall. They continued to rise. And it was the same story in the early 1980s, when we had 3 million unemployed, even higher interest rates of 17%, and again a deep recession. But this time again, house prices didn't fall. Now that is somewhat misleading, because if you have inflation of 10-20%, it becomes even more important to adjust house prices for inflation. Real house prices did fall 20% in 1975, and again in the early 1980s. But it was not a classic housing crash. Why did interest rates of 15 to 17% not cause prices to fall? One reason is that in the 1970s and 1980s, house prices remained quite affordable. In 2022, house price to income ratios reached a record level of 9 times. In the 1970s, it was closer to 3. That's a huge difference between then and now. In the 1980s, the economy started to change rapidly. Deindustrialization, the growth of financial services, and the first stages of financial deregulation, which allowed banks to lend bigger mortgages. In the late 1980s, the economy boomed. For the first time in the post-war period, the UK seemed to be outperforming its international competitors, with growth of around 4 to 5% a year. And it was an economic boom that particularly benefited the middle and home-owning classes, especially in the south of England. Awash with higher wages and a newfound confidence, house prices soared, especially in London and the southeast. At one point, house price inflation reached the dizzying heights of 35%. Mrs. Thatcher had promised a home-owning revolution, as council houses were sold off. And with house prices rising over 30% a year, who wouldn't want to get on the property ladder? But the Lawson boom had a dark secret. Wildly optimistic claims of an economic miracle were far from reality. The UK was living beyond its means. The high growth was causing a rise in inflation and a trade deficit. The growth was unsustainable. Inflation was becoming a real problem. Belatedly, the Chancellor started to increase interest rates. At first, the economy just shrugged off the higher interest rates. It took 2 years from the time interest rates were first increased for house prices to start to fall. And that's a classic example of how higher interest rates can have significant time delays. In 1990, the UK joined the exchange rate mechanism. Thatcher was unconvinced, but Lawson hoped it would help reduce inflation. The problem was that the weakness of the UK economy caused the value of the pound to fall, and the government were forced to increase interest rates to 15%. It was a disaster for home buyers who had taken out big mortgages at interest rates half that level. The combination of very high interest rates and falling house prices caused the economic bubble to pop. The UK economy lurched into recession. Unemployment rose close to 3 million, and thousands of homeowners found they couldn't afford mortgage payments. Arrears and repossessions soared. It caused an abrupt change in the housing market. Prices fell and homeowners were left with negative equity. In 1992, the UK left the ERM and interest rates were able to start to fall. Quite quickly the economy recovered, but the housing market was very slow to recover. Too many people had got burnt by high interest rates and falling prices. Even as the economy recovered, house prices stagnated. It was not until 6 or 7 years later that house prices started their upward trend. In the 90s crash, nominal prices fell 20% and real prices 35%. And the house price to income ratio had almost halved from 5 to around 2.8. It was a big shock, but few who bought houses in the mid-1990s could have predicted how much their house price would increase over the next 3 decades. In the early 2000s, house price to income ratios rose to levels even greater than the 1980s boom. It was helped by a strong economy, relatively low interest rates, and the deregulation of the mortgage market, which saw a growth in subprime lending with fewer checks on affordability. The traditional model of a mortgage was that a building society would lend out its own savings into mortgages. But in the 2000s, banks could be more profitable by borrowing on short-term money markets to lend out more profitable long-term mortgages. The result was an increase in mortgage supply. I personally benefited getting a self-certification mortgage in 2005. House price to income levels soared to record levels, but again we were told that this time is different. With a shortage of supply, surely prices won't fall. But in 2006, high inflation caused interest rates to increase, and a sharp rise in mortgage payments as a share of disposable income. And when the global credit crunch hit with an unexpected ferocity, the likes of Northern Rock and Bradford and Bingley couldn't borrow any more and were facing insolvency, and only government intervention prevented their collapse. Mortgage lending dried up, and the delayed impact of higher interest rates caused prices to fall 20% within a short time. Prices might have fallen much further except for 2 factors. Firstly, interest rates were cut quite dramatically to 0.5%. And secondly, the UK had never had a boom in building houses. In the 2000s, countries like Spain and Portugal, Ireland and Florida had also seen not just a boom in prices, but also a boom in home building. When the crisis hit in 2009, there were thousands of newly built houses that couldn't be sold. This excess supply caused a big drop in prices. This is why prices fell 50% in Ireland, but only 20% in the UK. And if we look towards 2023, whatever you think of the UK housing market, we can all agree that there's no excess supply of housing. There's been no boom in home building. In fact, recently, home builders have been cutting back because of the adverse market conditions. And so this shortage of prices will limit price falls, but importantly, not prevent them. Now, on the one hand, there are significant differences with the period leading up to the financial crisis. Mortgage lending is better regulated. There are more stress tests than pre-financial crisis. Many homeowners are better capitalised than in the past. Arrears are currently nowhere near levels seen in, say, the early 1990s. Banks have not been lending mortgages on a Ponzi-style scheme like in the past. However, one thing about economics and the housing market is that we often look at the problems of the last recession, the last crash. In 2023, there are different types of financial concerns. Years of stagnant wages, a cost of living crisis, have pushed many households closer to the edge. As interest rates increasingly bite next year, more will struggle to meet the cost of mortgage repayments. And although interest rates at 5% look much lower than the 1990s and 1970s, it's a very different scenario because house prices are now so much more expensive. As homeowners see their effective mortgage rate double when they remortgage, it could cause an increase in mortgage payments of around £500 a month. It's a real economic shock. So what do the lessons of the past teach us about the present day? Here are 7 takeaways. Firstly, the UK has never had a dramatic collapse in prices like you see in Florida or Ireland, partly because we've always had a relative shortage of supply. Secondly, the housing market is surprisingly volatile, with big fluctuations in house price to income ratios. Thirdly, the market is often quite slow to react to significant changes in interest rates. The rises in the late 1980s were still being felt several years later. Fourthly, despite a shortage of housing, this doesn't mean prices can't fall. In the short term, prices are really affected by changes in demand, which can swing dramatically. Fifthly, although real house prices in the UK have already fallen by 20%, history would suggest there's still more correction to come. House price to income ratios are still very high by historical levels. Sixthly, a big factor determining the housing market in 2024 will be the state of the economy. The last two big falls in house prices in 1991 and 2009 both occurred during a deep recession and rising unemployment. Currently, Bank of England forecasts for rising unemployment are fairly modest. The banks still predict we'll avoid recession. But if the impact of higher debt, falling real wages and higher interest rates hit spending and growth next year, as many fear, then unemployment could rise more than expected, and this will definitely change the dynamics of the housing market. Seventhly, the past can give some guidelines to what might happen in the future, but there's always a different issue. What was a big issue in the 90s was interest rates of 15%. In 2008-09, it was a global credit crunch and shortage of mortgage financing. In 2024, it may be something different, such as falling real wages. A big question is, how overvalued are UK house prices? And this depends on which way you look at it. If you look at it compared to renting, they're not too overvalued, but compared to house price to incomes they are. This video goes into more detail about how overvalued UK house prices are and how much prices may fall.